to people start in almost the exact same situation, with similar incomes, similar savings, and the same goal of building long-term wealth. Ethan has managed to save $60,000, and so has Daniel. Both earn around $60,000 a year and are looking for the smartest way to grow their money. But instead of choosing the same path, they go in completely different directions. Ethan decides to invest in real estate, believing that owning property and collecting rent is the best way to get ahead. Daniel, on the other hand, chooses the stock market. He invests his $60,000 into a total stock market index fund and commits to adding $350 every single month. Both are confident in their decisions, but their journeys look very different from the start. Ethan uses his $60,000 as a 20% down payment on a $300,000 rental property. He takes out a mortgage for the remaining amount, locking himself into monthly payments but gaining control of a large asset. From the beginning, it feels like a powerful move. He now owns a home that someone else is paying for through rent. Each month, his tenant sends money, and part of that goes toward building his equity. It feels real and tangible, like he's making visible progress. Meanwhile, Daniel's approach is much quieter. He invests his entire amount into the market and sticks to a simple plan: keep investing consistently and let time do the heavy lifting. During the first few years, Ethan feels like he made the smarter decision. His rental property brings in income, and everything seems to be working. Over the first 3 years, he generates around $19,000 in gross cash flow after mortgage payments. On the surface, that looks impressive, but slowly, the hidden costs begin to show up. Property taxes cost him about $3,500 per year. Insurance adds another $1,800 annually. Then come the unexpected repairs, a heating system replacement costing around $2,000 and exterior repairs costing another $3,200. At one point, the property sits empty for about a month and a half, costing him nearly $2,200 in lost rent. When he finally calculates everything, his actual profit over 3 years drops significantly, landing somewhere between $3,000 and $6,000. Daniel's experience over the same period is completely different. He doesn't deal with tenants, repairs, or vacancies. He simply checks his portfolio occasionally. Sometimes the market dips and his balance goes down, which can be stressful, but he stays consistent. He keeps investing $350 every month without trying to time the market. After 3 years, his portfolio has grown to around $85,000. He hasn't spent time managing anything, and there are no surprise expenses eating into his returns. One big advantage Ethan has is leverage. Even though he only invested $60,000 of his own money, he controls a $300,000 property. Over time, the property appreciates in value, rising to around $335,000. This increases his equity significantly. This is something that makes real estate appealing. Small initial investments can control large assets, but this advantage comes with risk. If the market goes down, his losses are also amplified because of the borrowed money. As the years go by, Ethan realizes that rental income isn't truly passive. There are ongoing challenges that require time and effort. Vacancies can happen unexpectedly, leaving him without income while still paying the mortgage. Maintenance costs add up every year, typically around 1% to 2% of the property value. Large expenses like roofing, plumbing, or HVAC systems are unavoidable and can hit at the worst times. Managing tenants also takes effort. Handling late payments, complaints, and repairs can feel like a part-time job. If he hires a property manager, he loses about 8% to 10% of his rental income, reducing profits further. And there's always the risk of bad tenants, which can create financial and legal headaches. Meanwhile, Daniel continues his steady investing journey. In the early years, growth feels slow and sometimes even frustrating. But as time passes, compounding begins to take effect. Around years 7 to 10, his portfolio starts growing faster. This is because his returns are now generating their own returns. By year 10, his portfolio is worth around $190,000 to $210,000. Ethan, on the other hand, has built up equity in his property, reaching somewhere between $185,000 and $205,000, depending on appreciation and loan payoff. Financially, they are very close, but their experiences are completely different. Ethan has spent hundreds of hours managing his property, dealing with issues, and carrying the stress of debt. Daniel has spent almost no time managing his investments. His strategy required discipline and patience, but very little effort. As time moves forward, the long-term results become even more interesting. After 20 years, Ethan's property is now worth around $520,000 to $580,000. His mortgage is nearly paid off, which means most of the rental income is now profit. Over the years, he has generated total cash flow of approximately $60,000 to $100,000. He owns a valuable asset that produces income, but his journey involved risk, effort, and ongoing responsibility. Daniel's portfolio, after 20 years, has grown to around $500,000 to $550,000. His total contributions over that time are about $140,000, meaning more than $350,000 of his wealth comes purely from compounding. He didn't have to manage tenants or deal with unexpected expenses. His investments grew passively over time. Another major advantage he has is liquidity. If he needs money, he can sell part of his portfolio quickly. Ethan, however, would need to refinance or sell his property, which takes time and effort. In the end, both Ethan and Daniel reach similar levels of wealth, but their paths are very different. Ethan benefited from leverage and owning a physical asset, but he dealt with stress, time commitment, and risk. Daniel benefited from simplicity, diversification, and flexibility, but he had to stay patient and handle market volatility. The key takeaway is that both strategies can work, but they suit different types of people. Real estate can be powerful for those willing to put in the time and effort, while index investing is ideal for those who prefer a hands-off approach. There's no single best path, only the one that fits your lifestyle, risk tolerance, and long-term goals. This video is for educational and informational purposes only. It is not financial advice. Investing in real estate or the stock market involves risk, and past performance does not guarantee future results. Always do your own research and consult a licensed financial advisor before making investment decisions.